So we're welcoming today Mike Manieri, who is a mortgage expert, and he's going to talk to us a lot about qualifying the buyer, the three main loan products today, as well as kind of what happens between that contract to close process. Our goal here is to help you as a real estate professional be able to help have a smoother transaction from beginning to end, from your first conversation with the buyer, being able to set those expectations properly, making sure they know everything that's coming, the connection with that loan officer, and then, of course, all the way through closing and having a successful closing. So, Mike, if you don't mind, share a little bit about your background and how long you've been doing mortgages and all the good fun stuff.
Yeah, thanks, Kevin. Are you able to hear me okay?
Yeah.
Okay, perfect. Well, where do I start? This is my 20th consecutive year in the mortgage business, and I've served almost every role in the business, obviously sales and management and leadership, but I've certainly served in some other roles at times, like processing, and which, by the way, I'm a terrible processor, just to put it on the record. But sometimes you do what you got to do based on market conditions. When we were restarting here in 2007, I went from running a huge operation to going back to being the receptionist and the processor and the salesperson and the payroll person and everybody in between. So do what you got to do. But anyway, I say all of that simply because it gives me pretty well-rounded experience level and knowledge base to share with all of you, and certainly share some basic information here, and happy to answer any more detailed questions as we go.
Yeah, definitely. So let's go ahead and get started so we can be respectful of everyone's time. We kind of talked about the three main components to today's call. The first one being qualifying the buyer. That's one of the questions I get a lot from especially newer agents that are like, well, what questions should I ask? What questions should I not ask? So what advice would you give to a real estate professional who's meeting with buyers on what they should do and what things you would look for as a mortgage loan originator to kind of have that handoff so that your first conversation with the buyer is an educated one and you're able to start everything off on the right foot?
Yeah, good question. So what I always say is I think it's a good idea to be dangerous enough to ask the right questions and to get a general idea of what kind of client that you're working with, but not so detailed that you potentially maybe give some misinformation, or maybe decide that it's not a quality candidate before talking to someone like me. So with that said, just some basic questions that I would ask in the very beginning that I do ask is, are you working? Do you make income? How long have you been working? There's exceptions to every rule, but typically you want someone to be on the job for 2 years. That's a very, very high level general statement. But if we're having a high level conversation here, typically you want someone to be on the job for 2 years or more. Secondly, how's your credit? You typically want to work with people that are a 640 or above credit score. I'm going to go into some of these details in just a second as it relates to specific loan products, but that would be a good target number to shoot for. We have programs that go down to 550, even 500 to be honest with you. But obviously, the more the lower your scores, the higher your down payment requirement, and certainly the worse your terms. But that's probably a fair number to shoot for as it relates to just having a high level conversation talking to a buyer.
But you mentioned about the 2 years on the job. What about if someone is same industry? So you were an assistant general manager at a hotel, for example, and you moved to a different hotel, same industry, but it was to a general manager's position. Does that kind of reset the clock, or is that still okay?
Yeah, that's still okay. And so, typically you're looking for someone that's been on the job 2 years or in that line of work for 2 years. So I'll give you a couple of fast examples. First of all, your example is good. They were, in a sales role, and now they're in a management role, but they're working for the same company. One thing that you want to be specific of, and again, I could get really granular, and so stop me if I do, but typically, if someone's going from, let's say, a commission-based job to a salary job or vice versa, you just want to be careful about that. Going from commission to salary is typically fine. Going from salary to commission is typically not fine. And there's more to talk about there, of course. Right. The reason being is that commission income is a moving target, and it can be great one month, it can be lower another month. Everybody on this call knows what that's like, myself included. So when a lender or an underwriter looks at that, they're saying, okay, show me a consistency of what you're making over a 2-year period, right? One thing I'll mention, and not to digress here, but I talked about credit for just a second. I just want to mention this because I get this question all the time, or it comes up. So as we all know, whenever I ask a client, hey, tell me about your credit, before I pull a credit report, the common answer is, oh yeah, I checked my credit through whatever, Credit Karma or some online consumer system, and my credit score was 660. So I should be good to go. Well, a really important piece of this that I'll share with all of you, and that I have to educate buyers on all the time, is there's a difference between a consumer credit report and a mortgage credit report. And so I'm giving generalities here, but in most cases, let's use that 660 model, right? If they're pulling a 660 score with like a consumer credit model, if you will, that typically is 30 plus points lower on a mortgage credit report. So that score might turn out for me as a 620, 630 when I pull a credit report. Why is that the case? Well, that's a good question, and I get that a lot. The answer is because pulling a mortgage credit report, a mortgage credit report is taking into account that person is most likely going to add a large or the largest liability on their credit report that they have or that they're going to have. And so that's factored into the scoring model, whereas it's not on just a regular kind of consumer report.
Very good stuff. Very, very good stuff. So what about documents? Do you recommend that a real estate professional kind of get them ready to go with potential documents that they should need, so that way when they meet with the MLO, they're kind of ready? Or should they just let the mortgage loan originator handle that because every person is so unique?
Yeah, good question. First of all, I always, I have this sort of saying, like everyone sort of do what they're best at or stay in their lane a bit, right? And I, myself included, like I get a question all the time. Someone will call me about their contract or some language in their contract or some sort of clause in there. And I say, hey, listen, like I could probably answer that for you, but I'm going to default you back to the realtor, in this case. Talk to them about that. They're the expert, in the field there, and they're probably more equipped to answer that question for you. In sort of the same way, as it relates to mortgage, what I would suggest is, and I can certainly do this, but any mortgage lender who you're working with, you should get a list of documentation that they're going to ask that buyer for. And if you want to get ahead of the game, which some of you do, and that's perfectly acceptable, obviously, that would be a good place to start. Hey, here's a list. Here's a short list of what your lender is going to ask you for. Know that they're going to ask you for that on the first phone call. And if you want to get ahead of it and start to collect documents, here's that list, and just know that they're going to ask for it. And by the way, like I said, I'm certainly happy to supply that list to all of you. And certainly, if you're working with another lender, they can do the same. But that would be something that's probably would behoove all of you if you want to get ahead of it.
Right. Now, let's move a little bit further in the pipeline here. The borrower is now speaking with the mortgage loan originator. Maybe we're moving forward now. We're under contract. What are some of the things that agents should and should not do? You know, talk about staying in their lane. Obviously, we've all experienced where someone in the transaction from contract to close has bungled the deal. Sometimes it's the real estate professional, sometimes a lender, not that you ever have done that, obviously, thankfully. Otherwise, you wouldn't be here right now. But, you know, or the home inspector, or someone who does something stupid and derails a deal. So what can the real estate professional, the realtor, do to help make sure they're shepherding the process along, but yet staying in their lane and not causing trouble?
Well, good question. And so, as I mentioned to you before regarding like a checklist from the lender, another good piece of documentation to get from the lender is a prospective milestone timeline view, right? And so what I mean by that is, there's certain milestones that should be hit, as we go through the process. And, that would be something as a realtor to be mindful of. If you're on day 10 of a 30-day contract and the appraisal hasn't been ordered, a red flag should be going up in your mind, like, hey, what's going on? Now, most cases, you're obviously going to be working with a lender or a loan originator that's going to really communicate well. That's something that I really pride myself on, and certainly my team. But you should be certainly in the loop as to how things are progressing as it relates, to the loan. As that, and I'm using a 30-day process, as that 30-day process begins to progress. So, again, I can certainly send out what a prospective timeline should look like. Well, one of the things that we do is we have a phone app, which some of you know, and certainly it's a way to follow along this loan process as it goes, and get some of these sort of milestone updates as you go. As it relates to preparing the buyer, my biggest advice there is make sure that buyer understands how important their timeliness is to having an on-time closing. I can't tell you how many times we've been in a rush situation where, we're getting up to the last week closing and we're scrambling around trying to continue to get documents from the buyer. And it certainly looks bad on us for sure, but it certainly doesn't make for an easy, smooth transaction. And the last thing anybody wants is a stressful environment. So any advice I could give here is, hey, like, if your lender or loan originator reaches out to you, that's a priority. Like, you gotta communicate back to them expediently and with the required documentation. And that seems to be a common theme at times, that buyers don't have the same sense of urgency that we do or that you do. And it makes us all look bad. So my comment there is, look, if the lender asks you for something, give it back to them within 1 or 2 business days at the most, because any time delay there just lowers your probability of potentially closing on time. We try to do a good job of getting ahead of that. Well, one of the things that we do is we will email and we'll call the person. So, I'm about to sneeze. Hang on one second.
God bless you in advance.
Yeah, I think it went away. When we take an application, we actually have a field right in the first section that says, what's your preferred mode of communication? And that can be text, email, or phone. And so why we do that up front is we want to know, look, sometimes people are at work and they will only text. I know people that don't take phone calls, right or wrong. I know people that don't check their email more than once a week, right? And so if you have a processor or a loan originator or even a realtor, sending messages to an email, wondering why it's going, unresponded to, then some of that's on us for not, really talking to that buyer and figuring out where best mode of communication is going to come from.
Speaking of communication, I know there's a lot of rules and regulations, privacy laws that come into play with information that a mortgage loan originator may have that they're not going to be able to share back with that real estate professional. What are some of those things that you could think of that, the typical realtor wants to know, right? They need to know because we're all control freaks in the real estate world. But unfortunately, due to privacy laws, your lender's just not going to be able to share that with you.
Yeah, great question. Well, first of all, that lends a little bit of credibility to what we talked about just a second ago, which was, what role should the realtor play in the financing piece? And, as I said, giving that prospective buyer that checklist is a really great start. And I think it's a good idea. Once you, as the realtor, start collecting non-public information from that borrower or buyer, listen, you have some liability on your hands, right? If that falls into the wrong hands, or it gets lost or something, you've got some liability there. And so, as lenders, we use, secured portals and all this kind of stuff to make sure that stuff doesn't happen. But, I would be very careful about that. But to answer your question, Kevin, specifically, which was,
things you can't share. Things you can't share with the professional.
Yes, good question. First of all, when someone's talking to me, I am going to give them every bit of information that I can legally give them to give the agent as much information as possible. Look, I know people in the business on my side that just have this very sort of aloof, like can't tell anybody anything. Everything's a big secret. And while there's certainly that part of it, I don't think that warrants. I don't think that gives a lot of security to the other party, meaning the real estate agent, which is what they certainly need and want. So let me give you a couple examples. I can say things like they have lower credit scores, they have higher debt ratios, they don't make enough money to qualify for the mortgage. They're off by 5% in their debt ratio. I can give you those kinds of relatively vague things, but giving you a very detailed sense of where the issue is. What I can't say is, hey, this person makes $90,000 a year. Their credit score is a 790, and they just got a raise yesterday. You just got to be real careful about those things. But I really believe it's important to educate the agent so that they're understanding of what's happening and giving as much detailed information as possible without betraying that trust with the client and in any confidentiality that applies there.
Yeah, definitely. I always caution agents, if a buyer sends you a document that's confidential that has any type of pay, income, and social security numbers, purge that from your email immediately, because we don't need that under any circumstances. There was a situation that happened a couple years ago in Tampa where a more tenured agent retired, but she kept copies of everything even after she retired, and one day decided to clean out her closet, threw everything out into a dumpster behind a shopping center. A homeless individual found the documents, called the local news station to try to get a tip reward. And of course, now, fast forward 5-6 years later, the brokerage is out of business from the lawsuits, and the agent is bankrupt, because they sued and successfully won some pretty serious judgments. So don't create that liability as a real estate professional. Let the lenders handle that fun stuff. Yeah. So as we move kind of into the different types of loans, I know there's a virtual product that can fit pretty much any scenario. But, we have the big three I tell agents. We have conventional and FHA and VA. And so that's one of the first questions I always ask every new buyer: are you a veteran? Because, hey, zero down is a wonderful thing. But kind of, if you don't mind, kind of looking at more FHA, VA, because I know conventional now, you can get some ridiculously low down payment conventional loans. Pros and cons to the two different paths, why a buyer would want an FHA versus a conventional, or vice versa, and then we can talk about VAs next.
Yeah, perfect. If you'd like, I put a few notes together here. I can share my screen with you and talk through some of those points.
Yeah.
If you want to. give me the ability to do that. If not, I can just talk through it.
All righty. Go ahead. You should have sharing options now.
Perfect. Okay, so. Okay, good. Can everybody see my screen there?
I sure can.
Okay. So, yeah, look, first of all, I could talk for literally weeks straight about loan programs, guidelines. I'll give you a quick example. Regularly, multiple times a day, I will go into into the guidelines and look up some obscure loan guideline to make sure that I'm understanding it correctly, and I communicate it properly to the person who's asking me. So there's tons and tons of loan programs, right? I'll just give you an example. Just FHA alone, just taking one loan program, there's over 1,000 pages of guidelines for just one loan program.
Wow.
And I just simply say, like, this could get as exceptionally granular, and I'm happy to answer some very specific questions. I'm going to keep this really light, one, for time's sake, and two, I think giving you as much information as I think you need on this call. So first, let's talk about FHA. First, for FHA, FHA is really, we tend to use FHA a lot for first-time home buyers. That's not to say it can't be used for other buyers, but first, it can only be used, any government loan can only be used for an owner-occupied property. And why we typically use this program for first-time home buyers is because FHA is by far the most forgiving on credit, down payment amounts, and debt ratios. And I'll talk about all those here in a second. So for credit, first of all, look, we can go down as low as a 550 credit score on an FHA loan. Now listen, I'm going to tell you, you got a 550 credit score, you worked hard to get a 550 credit score. That is a not easy feat here to do, right? But we do, frequently see that, and people have a 550 score for a reason. With that said, anything below 580 will require a 10% down payment at a minimum. So just wanted to say that to be said. But your typical FHA loan is a 580 or above. It's a 3.5% down payment. And the debt ratios can go as high as 56.99%. And don't forget, we use the gross income, not the net income. So that's a really, really high percentage to potentially qualify buyers with. So to use really, really simple math, if someone makes $1,000 a month, they can qualify potentially with up to $569 a month in payments, including their mortgage. Now that was simple math, of course. So, probably that's not going to be the case for houses that you're looking for, but that gives you just a general idea of how that works. And it's very forgiving as it relates to credit scores. So we're going to talk about conventional loans in just a second, but typically first-time home buyers have new credit or not perfect credit. And so, like I said, FHA is the most accepting of that, and they're forgiving as it relates to qualification and rates. So as an example, there is a very, very minimal difference in rates between a 640 score on an FHA loan and a 760 score. I mean, there might only be an eighth of a percent, maybe a 0.25% at the most in rate. And that is a huge disparity in scores, okay? And then also, frankly, because of the flexibility in the scoring and the debt ratio, FHA loans are just easier to get approved. There is I do a lot of these kinds of calls and a lot of trainings and a lot of presentations. And, a question I get a lot is, hey, Mike, we've learned along the way as real estate, agents, we've learned along the way that FHA appraisals are much harder to get done or that FHA loans are riskier for my seller. Is that true? And I am here to debunk that thought process. And so that may have been the case a long, long time ago, but I will tell you, if anything, it's the opposite. As it relates specifically to the appraisal process, the only real difference in an FHA appraisal versus a conventional appraisal is that they're gonna check and make sure that the water and power is on. They're going to check to make sure that the water runs, and they're going to make sure that the electricity works. And the only other real difference is that they're going to inspect the attic. That's it, guys. That's it. I mean, there may be some other little nuances, but those are the main things that they're going to do that typically wouldn't happen in a conventional appraisal. Okay. So, and then secondly, like I mentioned earlier, an FHA loan is much easier to qualify that buyer. And those loans are closing in the same amount of time as a conventional loan. So there shouldn't be any issues there, as it relates to, the time frame and stuff.
Hey, Mike, one thing we just came across yesterday actually is, we have a lot of these iBuyers in the market, like Open Door, and FHA requires the property be owned for, I think it's 90 days, correct, before it can be sold again. So if you're looking at homes with an FHA buyer, they need to be cautious about looking at when that deed was recorded from when Open Door purchased it in order for the deal to go through, correct?
Yeah, really glad you brought that up. And certainly that's something that we look for when we take an application and find out what the subject property is. But as agents, that is a fantastic thing that you could do as a quick property search. Go to the property appraiser site, and in probably 5 minutes, you could just see the history of ownership. And FHA is the only one who has this rule, and they call it the 90-day flip rule. And what that 90-day flip rule says is the seller has to own the property 90 plus days before the new buyer can buy it and finance an FHA loan. So what that means is from the date that seller purchases that home and the deed is recorded, that's when the timeline starts, to the day that we pull what's called the FHA case number for the FHA loan and to qualify the borrower. So yeah, very good point. Now, in some cases, we'll just simply wait. In some cases, we'll explore other loan products. But yeah, that's a deal killer if it's not vetted out in the right time frame and as it talked about early and on in the process.
We literally just had this happen yesterday, which is why I'm like, and I haven't seen that. I mean, 3 or 4 years ago, it was a problem when we had a lot of foreclosures on the market and a lot of flip activity happening. And so it was just kind of had gone dormant in my brain a little bit and never even thought about it when it comes to the iBuyers like Zillow offers and Open Door and a couple of the other ones, right? So it's something just to keep in mind. Yeah,
so good point. Thank you for bringing that up. 2 other quick points I'll just mention that, as it relates to an FHA loan. If there's a downside to an FHA loan, it's simply that the mortgage insurance is for life. It's for the life of the loan. So even if someone's putting 40% down, they're going to get mortgage insurance. Now, if they put 10% or more, the mortgage insurance drops off after 11 years. You typically don't see that for an FHA loan, but just sharing that in case that does happen.
I did not know that about the 10% part. I thought no matter what, it stayed on.
Yeah, so either 10% or more, or if you do a 15-year as opposed to a 30-year, each of those options have a just an 11-year, versus a life of the loan, requirement.
Right.
Okay. And then, FHA allows for up to 6% in seller concessions. I know that those can typically, at times, be difficult to negotiate. So even if you negotiate a couple percent, that can help the buyer great, but it does go up to 6%. Okay.
One question on the concessions. I love situations because it helps us learn. Where the 3.5%, my understanding is by federal statute, that has to come that can't come from the credit, right? It can't come. It has to either come from a gift from a relative or from the borrower themselves. Like, we as a realtor can't give part of our commission towards it, or it can't come from the seller. It has to come from the borrower. Is that correct?
Yeah, so the 3.5%, as you see me highlighting here on the screen, the 3.5% down payment, and don't forget, down payment is separate from the closing costs, right?
Yeah.
Down payment lowers the loan amount. Closing costs are just simply costs that are associated with the loan process. So, yeah, a 3.5% down payment or any down payment, amount has to come from either the buyer themselves, documentable, assets, or it has to come from a relative, family of the of the buyer, or it can come from like an approved government entity. So when I say like an approved government entity, sort of these down payment assistance programs, if you will, that are put on by the state or the local, municipalities, that kind of thing. There's county, city, state programs. So those types of things are approved. It cannot come from what's called an interested third party, meaning like the agent couldn't contribute part of their commission towards the borrower's down payment. All right, makes sense?
Yes. Yeah.
All right, any more questions on FHA before I move on here?
We do have a question from one of the attendees. How stringent are the FHA appraisers regarding conditions of the home, windows operable, for example, or GFI outlets, etc.?
Great question. Very good question, actually. Thank you for asking that. So don't forget, an FHA loan is taking into consideration that the buyer is going to live and occupy that property, right? The reason why conventional loans are a little bit less strict is simply because the buyer may not, occupy the property. So with that said, the appraiser is looking for things like a working kitchen. So I'll give an example. We had a situation where we were doing an FHA loan, and there wasn't a stove. So no big deal. The loan still goes through. The appraiser just simply makes a comment on the appraisal that says, hey, notated no working stove, and simply sometime between now and closing, we just have to document that somebody put a stove in. It could be a $100 stove that you got off of freaking Craigslist if you want, but as long as we can document something's in there and that it works, so that when somebody takes occupancy of that property using an FHA loan, they have a working kitchen and they can eat in it. And don't forget, the only things that we have to quote unquote fix to qualify for the FHA loan are just things that are included by the appraisal in the appraisal report. And I stress that because sometimes there's some confusion around, around the home inspection and around the appraisal report. So the home inspection is going to show a zillion things wrong with that house, even if it's a new construction home. That's what they're there to do, right? And it can certainly scare your buyers at times. So, being able to sort of prep them for that is a good move on all of your parts. But we don't care about about the home inspection. We don't want to see it. Don't send it to us. If you send it to me, I'm shredding it. We are only going to go off of what the appraisal says and what that appraiser comments on. So again, that is always way less than what a home inspector says. So I've had this question a few times in the past. It's like, hey, Mike, how do I know what the appraiser is going to say, and how do I know how much it's going to be? Well, the answer is you don't. I mean, we could talk through it, and I can probably tell you what stuff is that they're going to catch and what stuff they're not. But what a good practice is to get the appraisal ordered right away in the very beginning of the process. The buyer risks the cost of an appraisal, which is anywhere from $450 to $500 in most cases, to find out what that number is. And they'll put it right on page 1 of your appraisal report. It'll say what's called a cost to cure, and they'll say, hey, we need to put in a new stove, and we need to fix, wood rod on the front door, whatever it is, and the estimated cost of that is $600, and then all you do is you go out and just fix those things. And typically they're real minor things, and it never stops a deal from happening.
Cool.
Was there another question here? I think I saw one.
Nope, that was it. I thanked him for the question.
Okay, good. Did that answer your question? You can type back here, and if it didn't, I'm happy to go into it more.
He said, yeah, good deal.
Okay, good. Okay, let's talk about a conventional loan. So a conventional loan, don't forget, FHA loans were originally designed and created for these sort of first-time home buyer, lower credit people. That's not to say that's the only people that do those loans, of course, right? But that's how it started out. And then conventional loans were originally designed for people that had great credit with lots of money down. That's just how they were originally designed, okay? So keeping in that theme, typically conventional loans are given to people who have good credit and who have money down. Now, it doesn't always work that way, but I'm just giving you very, very, very general information here, okay? Conventional loans are much, much less forgiving as it relates to debt ratios and credit scores. So in that example I gave where there's not a huge disparity, maybe like 1/8% from a 640 credit score to a 760 credit score in my FHA example, right? If you do a 640 credit score for a conventional loan versus a 760 score, I mean, there could be as much as 0.5% or 5 to 7/8% in difference in rate, because that's how sensitive they are, as it relates to scoring. And by the way, not to go back to FHA again, but that's why FHA has that mortgage insurance. They have the mortgage insurance to protect them. It's a safety net. They're saying, hey, we're going to take more risks because we're a little bit more protected because we have mortgage insurance on every single loan. Mm-hmm. Okay. So the maximum debt ratio for a conventional loan is 50%. Now, 45% is ideal. Exceptions can go to 50. So again, that's obviously less than an FHA loan. Credit scoring, we talked about that, of course, already. And there's the option with a conventional loan of a 20% down payment or more, and you'll avoid any mortgage insurance. Now, just to touch on what mortgage insurance is for a second, because some of you may be wondering what that means, and some of you maybe already know, so just you can kind of tune me out here, but mortgage insurance just protects the lender. Just protects the lender. Let me say it again. It does not protect the buyer, okay? However, look, lenders base pricing on risk. It's very simple. So if a buyer puts 20% down, a lender looks at everything and says, okay, what's my exposure here? What's my risk? And if that risk is obviously a default, because listen, a lender makes money when they lend out money, and either they close on that loan and they sell it to another lender for a premium, or they service it and collect interest with the loan payments, right? That's how a lender makes money. So if a buyer puts down 20%, a conventional loan says, you know what, we don't need mortgage insurance because we feel that we're protected enough. If that buyer defaults, we take the property, and most likely there is going to be some equity that we can resell and make money with, and we're okay, right? And anything above 80%, they say, hey, we don't have that protection, and we're gonna put a mortgage insurance, attached to that payment so that we can kind of protect ourselves here. Okay, does that make sense? So yeah, very often a conventional loan is typically for people who have really, really great credit. When I say what's really great credit, 760 scores and above is about as good as you can get. And the pricing is impacted with a conventional loan every 20 points, right? So if you have a 760 score and that score drops to 740, your pricing is negatively impacted. If it goes to a 720, it's a little bit negatively impacted, 700, 680, et cetera. So there's 20-point increments there. So why I share that with you is because, look, if a borrower has a 730 score and it goes to a 740 or 735, if you will, it really makes zero difference as it relates, to qualification and to pricing.
So why would a borrower, what are some of the reasons why, I'm going to rephrase this, someone would look at a FHA 3.5% versus maybe a 5% conventional?
Well, just simply some of those reasons I talked about. Look, let's be honest, right? So a reality in our market right now, and over the last 6 months, we've all seen a bit of a leveling out, which I think, by the way, is good, and that's a healthy thing for the market. We all, or some of us, probably experienced the 06, 07 crash where it just kept going up and up and up, and it never stopped, and it crashed, right? And we were starting to see that through 15 through 18 here, and the fact that it's leveled off a bit is actually a good thing. So look at that in a positive way. But what's happening is the prices have gone up substantially over the past 4 or 5 years, but the average income has pretty much stayed the same. And so what we're seeing now is that, potential home buyers are having to qualify at the maximum possible qualifying ratios. And that's becoming a real common theme right now when we approve buyers. So having more flexibility, this 56.99, and we got a little bit more flexibility on the VA as well. Having that flexibility is huge when it comes to qualifying buyers. I can't tell. I would venture a guess, and I don't have this statistic off the top of my head, but I would venture a guess that at least 50 to 60% of our buyers get approved for their financing between 50% and 56.99% when they qualify and they close on their loan. That is a gigantic number. So what does that say? That says that that's why we're seeing a leveling off, because some people are like, hey, I just can't afford to buy a house right now, right? But so to answer your question specifically, Kevin, typically we see people do FHA loans over conventional for the flexibility in the debt ratio and the forgiveness on the credit scores.
The other thing I'll point out too, and hopefully you agree with me, I'm not making an incorrect statement here. With the FHA, once the lender has approved the loan, the mortgage insurance is also approved. It's kind of a package deal. Where on the conventional, if we're having to go with mortgage insurance because we're sub 20% down payment, then there's a second kind of underwriting that has to happen with that mortgage insurance provider. And there is a possibility that right before closing could blow your deal.
It could happen. It's never happened to me, but yeah, I'm certainly aware of that happening. But it's another component that could take a little bit of a risk off the table, again, with doing an FHA versus a conventional. So thanks for bringing that up.
All right, so now to our veteran program, the VA loan. I love that it's 100% financing. I love that the down payment is their service to our country, and what a great way for us to be able to give back to our veterans. So obviously they're a veteran, they qualify. What are some of the big pros, and are there any cons to this VA loan program?
Well, there's very few, if any, cons. Obviously, right. One of the big requirements here is that you have to be a veteran or a spouse of a veteran. So there's a survivorship, if you will, of rights. So let's use a scenario in which a serviceman is married to their spouse, and the husband who served in the military passes away. Well, those rights are passed on to the spouse, and that spouse still has the ability to use those rights and to get a VA loan. But yeah, so that's a big component. Obviously, you got to have that. If your buyer has that, and Kevin, you make a really good point. That's a great top 5 question that you should be asking someone when you first meet them. Are you a veteran? Because there's certainly lots of advantages here. again, and this program is designed to help veterans. It's very simple. So it's designed very similarly to an FHA loan, and it's very forgiving on credit. It's very forgiving on credit score. Similar situation. There's not a huge disparity in rate and I just use this same example from a 640 to a 760. And what's really great is there's 100% financing. The biggest obstacle I see right now in my 20 years in business and on a day-to-day level with home ownership and qualifying buyers is down payments, money to closing. And so don't forget, you've got your down payment piece, which can be anywhere from 3 to 20%. And then you've got your closing cost piece, right? And again, some of that can be made up with seller concessions and things like that. But that can add up depending on what your sales price is. So if you can doing a VA loan and getting 100% right out of the gate, that is a huge win as it relates to qualifying more buyers. Technically, and I'm using this example for a VA or an FHA, but look, if the VA buyer has 100% financing, if the agent in conjunction with the loan originator can negotiate seller concessions, typically 4%, which is the max for a VA, should be enough. Hypothetically, they could come to closing with no money. Just they got to pay for their inspections. But that's it. So huge value add, of course. I'll tell you a quick story too. I had a loan. This is going back probably 60 days or so. We had a loan where it was actually a turn down from a bank. Veteran came to us and they were buying a house, had good credit, and their ratios were too high, and that was the reason why they were turned down from the other lender, a bank. I think it was a bank actually. And as I mentioned, VA is lenient on things like this, particularly for veterans, right? So their ratios were very high, but when we ran our automated approval engine, which we do for all of these loan types, we got that loan approved with a 64% debt ratio. 64%. Meaning, again, using easy math, if they make $10,000 a month, they have $6,400 in in bills. That's a large number, right? So typically a lender or bank wouldn't even consider running an automated approval for fear that they wouldn't get it approved. But obviously we're going to unturn every stone here, as you know. And so we were able to get it approved, closed in a couple weeks, and this buyer was ecstatic. Nothing more rewarding as well for both the realtor and the lender to be able to put a veteran in a home.
Yeah, definitely. Now with a VA loan, there is a funding fee. So this is what I would, maybe consider a partial con, if you will. So is that something that they have to pay as part of closing costs, or can that be rolled into the loan?
Yeah. So there is no monthly mortgage insurance, similar to how it is with FHA or potentially conventional. But there is what's called like an upfront fee, or a funding fee. And by the way, FHA also has that as well. However, that fee is rolled into the loan. So that's a varying number depending on the status, how many times they've used it, their years in the service. But the average first-time use is a 2.15% funding fee. So if they are doing a sales price, and again, guys, I'm using some really easy math here. If they bought a $100,000 house and they had a $100,000 loan, their loan would actually be $102,115. Okay, because they're rolling in that. Now, that's the case for all VA, all FHA loans. So that's the same no matter who you talk to or where you go. And again, it's such a nominal difference in payment. It's almost irrelevant to talk about. But we obviously certainly educate the buyers on that when we talk about these these loan program options.
Right. And one added benefit too, if the veteran is a 100% disabled service connected veteran, the funding fee is waived. And also in the state of Florida, they don't pay property, their ad valorem property taxes are zero. So that's another benefit as well.
That's correct. We actually just did one of those this month.
Yep.
And no property taxes and no upfront mortgage insurance.
Yeah. It helps, definitely. So last thing I really wanted to hit on is kind of that contract to close piece, because there's, a lot of buyers don't realize, and even agents sometimes, everything that's going on behind the scenes from the finance side. So if you could just kind of at a high level, we only have about 9 minutes left, at a high level, walk us through what happens when, you've got that contract that comes in, what's going on behind the scenes, all the way up to that, the stack of, hundreds of pages have shown up at the closing agent for signature.
Yeah, well, absolutely. Let me touch on that. And then I've got a couple other quick notes here I'll share with you before our call of just common things that could screw up a deal that you want to be aware of. So I'll tell you a quick story. This is going back probably 18 or 19 years, but when I first got into business, I was going through qualifying a buyer. And as I'll talk about here in a second, there is tons and tons of paperwork that you have to go through to figure out if somebody qualifies or not. Well, as I'm going through this process with my buyer speaks up and is clearly annoyed by my questions and interrupts me and says, "Mike, listen, I don't get it. What's the problem? You punch a couple numbers into your calculator, tell me what it is, and let's just go ahead and let's go to closing."
If only.
So first thing is it was a conversation that I remember to this day. But secondly, I clearly didn't do a good enough job of setting the proper expectations here. So I went backwards a bit and set those because they were not even close to understanding how this works. But look, in almost every situation, we're documenting tax returns, pay stubs. We're verifying employment with their employer. We're looking at W-2s, financial statements like bank statements and trust accounts and savings accounts and money market. List goes on and on. We're doing a loan for a friend of mine who has a trust, and just his trust document alone was 416 pages. Just one document, right? So they aren't all like that, but yeah, there is so much that goes on behind the scenes. And when you're a loan originator, a processor, or an underwriter, and every file is certainly different, very often there are literally hundreds and hundreds of pages of documents that we're going through before we can qualify that buyer and make sure that they're approved. And so, I don't know, one of the things that I would encourage every realtor to do, and I'll certainly open this up to my, to my office, but come meet the team, come see the people, see what they do, get your head around, kind of how it all works. And, we'd be happy to walk anybody through what the process is like and what actually goes on behind the scenes. Cause it's, it's a lot of stuff. So I realized that was an exceptionally vague response, but I could get lost in a lot of those kind of details there.
Right. And so kind of the last really big bullet I want to hit, you kind of talked about it. What are some of the things that buyers can do that will blow the deal? I love to share a story. We had a buyer who decided to go and increase their debt by about $75,000. They were barely able to get approved, go out and they bought a brand new BMW before closing. They got that solved, and then he did some more stuff, and finally it blew the whole loan. I had another one who had $12,000 in cash under his mattress from bonuses, and he decided to, go deposit that which was interesting. And my favorite one, I had a borrower, $96,000 house, hardworking blue collar electrician. They did a lot of rewiring, and his boss allowed him, totally legit, to take the old copper to clean it, and then he could recycle it and keep the money. So he had all these extra deposits that were in his account, and underwriting's like, well, we need receipts. And believe it or not, he had a shoebox full of crumpled receipts. We sat down with the processor, and we literally taped all these hundreds of receipts to paper. So, but he put deposits in. So what are some of those things that just, blow the deal?
Yeah, good stories. Thanks for sharing that. You're reading my mind a bit here. As if you look down on my screen, I added some of these here at the bottom, but I'll tell you, the most common issue that we face that could potentially blow up a deal or seriously could delay it is cash deposits or unsourced deposits. So here's the deal, right? Regardless of how great the buyer's profile is, they got to meet the loan guidelines. And I talked to a buyer, I was a loan originator, but was having a hard time. They were sort of really frustrated, and he was this high-end buyer, and they made tons of money, had great credit. And so they said, Mike, do you mind jumping on a call and talking to this guy? And so I said, sure. So I jumped on the call. The guy's like, hey, Mike, look, I make tons of money. I make, X amount of money a year. I've got an 800 score just to prove my loan already. What's the problem? And I said respectfully, first of all, I want nothing more than that. Because nobody makes any money and you don't get in your house, and unless that happens. But look, in the end of the day, no matter who you are, you have to meet the loan requirements, or you have what's called an unsaleable or uninsurable loan, and no one's going to do it for you. I don't care who you are, right? And so with that said, one of the biggest obstacles or things that get in our way is cash deposits. So, here's the thing. I have buyers all the time who are like, hey, Mike, listen, I got 15 grand in my checking account, and that should be more than enough money to bring to closing. So I'm ready to go ahead and get me qualified. Well, the lenders, FHA, VA, conventional, these loan programs, they're very specific. They have to document that those are your funds or from an acceptable source. So it doesn't matter how much money is in your bank account. It more matters where it came from, okay? So we have to source it. When I say source it, how do you source it? Well, look, if it's a payroll direct deposit, simple. There's nothing to do there. It shows your company's name on it. It's a direct deposit into the account. We already verified that you work there. There isn't anything to talk about. But if you go deposit mattress money like Kevin talked about of $1,000 or $10,000 into your account, guess what? That's a problem. And so in most cases, we have to deduct that amount from your qualified assets that you can use to go close on this property. And we run into this all the time. That is the biggest obstacle that we run into on a day-to-day basis. So if you could advise your folks on anything, it would simply be before you deposit anything, talk to your lender. And by the way, just so you know, I have tons of creative ways to make this work, just so you know, and we do it all the time. But a lot of times you need time to figure it out. Like, I'll give you one quick example. FHA only requires that we season your funds by 30 days. Conventional wants 60 days, meaning that they're going to look at your bank statement for 60 days and see all of your deposits and your balances. FHA only looks at 30 days. So, a creative way to get around this is like, hey, go ahead and deposit whatever funds you have, but we're going to have a 30-day bank statement before closing, a recent one that doesn't show any of these cash deposits, because those are then not usable assets, right?
Yeah, we have a customer disclosure. It's a 2-pager that we have every customer sign, and there's 2 paragraphs. One's credit inquiries and additional purchases using credit, and large deposits or withdrawals from bank accounts basically saying don't do jack without talking to your loan officer.
Yeah.
If it's anything outside of the normal things that you would do and have been doing already, established behavior patterns, don't do it unless you talk to them.
Yeah, no question. And good thoughts on that. You already mentioned, I'll just, don't add any new debt during the loan process. Don't forget, we pull a credit report. That's what we're using. However, at the end of the process, every lender and bank is required to pull what's called a soft credit report, which doesn't impact your scores, within 10 days of that closing. So if you raise your debts, if you add a new liability, we're going to find out about it. And it could potentially blow up that deal. As I said, a lot of our buyers are qualifying at that maximum number. And so if you throw in an extra couple $100 a month, that's in many cases a deal killer.
Well, I have a question. I know we don't have any questions from the group, but I have one because I keep hearing this term, and I'm sure others maybe have this question, just haven't thought to ask. I'm hoping I'm not the only one. But what is the difference, besides impacting of score, between a hard pull and a soft credit pull?
Yeah, just give me 1 second here. I'm going to plug in my computer because it's about to die any second.
Uh-oh. Yeah, don't do that. That'd suck. I love that you have your big name on a wine label on the wall. That's hilarious.
It was a wedding gift. So it was for my wedding. So good question. So a hard credit pull is what we do in the very beginning of the process. It shows what the scores are, all of the credit versus the liabilities, your pay history, et cetera, et cetera. A soft credit pull is one that doesn't generate a score, doesn't impact your credit scoring in any way, just simply shows an update of any new credit liabilities or any new balances and payments. Okay, but you have to have at least one hard credit report in the file to approve the loan. That's why we always do that up front. But in the end of the process, we only pull a soft credit pull just to make sure we have an insurable and saleable loan, knowing that the buyer hasn't increased debts, and if they did, that they still qualify, and that and we do it that way, of course, so we don't impact their score.
Awesome.
So I know we're running short on time here. I'll just add this one other thing, and then I'm going to open it up to questions, and then we're done. So this is something that I educate buyers on consistently, as recently as an hour before this call, and it was a client that you and I have talked about very recently. The relationship of credit limit to credit balances. This is probably the most important thing that can impact credit scores, right? So I'll tell you, I pulled a credit report, I don't know, let's just go back 3 weeks because this is one that kind of stands out in my mind. And that credit report, that borrower never missed a payment, ever. In 7 years of credit history, never missed a payment. However, had a 625 credit score, which is relatively low. Sure. And the reason that person had a 625 credit score is because their limit to balance ratio was way out of whack. So they had many credit cards, as an example, and if they had a $1,000 limit, they owed 900 or 950 or even more than 1,000. That is the most impactful thing, other than just like flat out missing payments that you can have. So a general rule here is, and you can certainly feel free to educate your clients on this, and this is something that your lender should and will be talking to them about if they talk to us, but they should keep all of their balances at a 50% limit to balance. So if they owe if their limit's 1,000, they should never have a balance over 500. If they can keep it to 30%, that will be optimal for the scoring modules. Okay. Mm-hmm. If they're really leveraged and they owe as much as they can borrow, the credit reporting agencies just look at that as a huge risk. They're a couple more payments away from maybe not being able to afford anything. If they can keep them at a reasonable level and they can pay them on time, now they're just responsible credit managers. And that's how a lender wants to look at that. And that's how a scoring module is going to look at that as well.
Awesome. Well, we've got one question came in from Jim Parton. How much of a concern, if any, is cloth wiring in a home for a lender?
Hey, Jim, thank you for the question. Is it say cloth wiring, CLOTH?
Yeah, it's definitely an insurance issue, but I'm not sure if it's it can catch fire. It's kind of like in the same category as aluminum wiring and Federal Pacific panels.
Yeah. So what I would advise you on is, first of all, there's a pretty good chance that's not going to show up on an appraisal report, and it's probably something that won't affect your financing, but it is definitely something that will show up on your 4-point inspection or your home inspection. It will certainly impact the cost of the insurance, and it's absolutely a safety hazard. So as a responsible agent, I would simply advise your client, hey, like, you probably want to do something about this, and take it into consideration as something that they would potentially want to replace when they moved into the home or even prior to that.
Yeah, actually, the same gentleman I talked about, the electrician, his house had an FBE panel, and he got them to allow. He basically changed out the panel for the seller. And all the seller he has to sell to is buy the new panel. I'll come change it for free. So because he wanted the house, and the insurance wouldn't write on it. So
yeah. Like, I had a situation where we just had to change out. It was actually a property I was selling, and it had a Federal Pacific box, as you were talking about, which is just a really old box, which really impacts your insurance. And so we agreed that I would pay for it, and we increased our sales price accordingly. But it was something that the buyer didn't have to come out of pocket with, and it was going to save them like $500 a year on insurance. And this was a relatively lower price sale, so that was a huge number.
It's rare you could even find insurance companies that want to finance FPE or polyethylene piping and that type of stuff anymore. They're getting harder and harder to find, and when they do, it costs.
Yep, absolutely.
Well, great. So we had some great questions. I mean, any final thoughts before we sign off here?
Not for me. I like to be very true to the timelines, and I like to really commit to that. So I realize that we're a couple minutes over, and so I will just leave you with. Feel free to reach out to me directly. Kevin can certainly pass on my phone number to any of you. Happy to have any one-off conversations about any of your buyers or your situations or anything where I can just advise you one-on-one, even about about your personal stuff. I am. Like I said, I'm just here to be a resource, and I am, here to help, and I enjoy doing that. So definitely use me, okay?
Definitely. Well, thank you so much, Mike, and I appreciate everyone for joining us, and those that are watching the replay down the road, thank you for tuning in to our little mortgage talk. Mike and I talk. We'll probably be doing some more of these, and maybe spending some time drilling down on what makes up a credit score or different things that you find interesting. So thank you so much for tuning in, and have a great day, everyone.